Last week on Wealth Talks, we promised we would talk about a case study, and so today you're going to meet Jacob.
It all started when Jacob's mother referred him to our office. She was already a client who had been referred. And once Jacob graduated from college and got a nursing job, she wanted Jacob to be able to save money. Jacob took that to heart, contacted us, and then we got the opportunity to help Jacob with his plan.
One thing that I really like about Jacob and what he's done with his infinite banking life insurance policies is he realizes that you can't wait until retirement to enjoy a bit of retirement. So I think one of the first things he did was travel by borrowing from his policies and using that as a cash flow to allow the travel that he wanted to take place. But then when the NBA finals were played in his city, he actually spent money to go to those NBA finals because he thought it was going to be a once-in-a-lifetime thing. And he was able to do that by borrowing from his policies and then paying them back as it was convenient for him.
And that's exciting because a lot of people think that, oh, I've got to save money for retirement, save money for retirement. Someday they're going to be in retirement and get to do the things they want to do. But Jacob realizes you can enjoy a little bit of retirement all along the way.
And they do that. Most people save and basically hoard their money in places that will penalize them if they actually try to use that money until they're 59 and a half or older. And that curtails the ability to take a little bit of retirement every day and enjoy the journey of living.
There is a process, though. Jacob just didn't contact us, decide to do infinite banking, get a whole life policy, and immediately start taking trips. So there was a starting point.
What happened is that Jacob's mother had bought policies on Jacob and his brother when they were younger. And she had contacted our office to find out how to use those policies better because a friend of hers had referred her to McPhee Insurance, who had been referred by another friend who had heard us on the radio when we were doing a radio show back in the day, and now we do the podcast. But his mother, Jacob's mother, had purchased policies that really don't work with infinite banking. So we were able to help her transfer those over to policies that would. And then she told Jacob and his brother, you are going to be watching if you can manage your own finances well, then we're going to transfer these policies ownership back to you. And of course, Jacob took the challenge and did it. And then a few years later, he decided, hey, this is working so good with the policy Mom started on me. I think I'm going to start my own policy.
I remember you talking about how when you talked with Jacob, you asked him how much he was worth. And you often use the 10-20-70 principle as you're helping people figure out what size of premium is going to be affordable and comfortable for them. What was Jacob's response?
It's a response that most people give when I ask that question is, I'm worth a lot of money. I mean, most people realize they're worth more than what they're getting paid.
So we're not talking about, oh, I have a lot of money in the bank, I have a high net worth. They're realizing, hey, I am valuable.
Yes.
If I was going to my employer, I'd want them to pay me a whole lot more than they are. That's really what I want. And so they're recognizing I have value.
And just like anything else that has value, whether it's our car or our house or maybe some special piece of furniture or something, we want to insure that to make sure that the value of that is not lost should something happen to it. And so life insurance is insuring the value of your life in case you're not there. What are people going to be able to do after you if your income and your input into their life isn't there? And Jacob, even as a single person, was really responsible and understood that he had a lot of value to offer to the world as a nurse and later on as a husband and possibly a father.
And in the financial world too, you hear you've got to pay yourself first. And so while the death benefit is something nice, that's what comes with the life insurance policy, we're also focusing on paying ourselves first, making sure that we get a portion of everything that we make saved for our future. But with the life insurance, we get to keep it, use it while we're saving it. I used to think that paying ourselves first meant that we were buying our groceries and paying the mortgage and the utility bills. And so when you're asking that question to people, how much are you worth? You're asking, how much should you be saving for yourself, for your future, for keeping?
And because Jacob was able to realize that he was worth a lot more than he was paid, he was able to put a substantial amount away in his life insurance policies. And then when his mother ran into some financial issues in her life, he was able to take from what he had been saving for the future and use it to help her keep her house.
That's really commendable. Yeah, for Jacob to recognize that he is worth, a certain percentage of everything that he is making, to be able to put that away at a young age, and then to be not only to be able to travel and to enjoy some of the things that he wanted to enjoy, but also to be able to help family at a relatively young age. That's a wonderful story. A lot of young people today would do great to look at what Jacob has done and to model their own finances in a similar way.
And he did it just by using that 10% of his income. So you think about a nurse just getting started in their job. What is their income? Well, whatever that is, using 10% of it is a great place to start. And whether you're a nurse or whether you're an Uber driver, an executive, or a lawyer, it doesn't matter. 10% is a great place to start. And that's where Jacob started. He started with his 10%. And over time, that grows because it's kind of like paying a mortgage. And the more payments you make, the more you own, the more equity you have. Very similar in a life insurance policy. And then that gives you more flexibility with what you can do.
I remember Jacob was really excited to always come to our events that we held because he said he always took something new home with him. Whether it was talking with the other people that came to those events or whether it was from the platform that we were sharing information, he said he always gleaned something new about how to manage his finances. And that's what infinite banking really is all about, is how to manage your finances so that more of what you make stays with you instead of being transferred to the people that we're doing business with or the people that we have to pay our bills to. Because otherwise, we just have a job that we go to work at, and we transfer that money to someone else, and then we go back to work. Whereas if we put that money into a participating whole life insurance policy, now we can maybe pay a bill or purchase an asset or buy a car or even buy a house, some people have done now. And when they make those repayments, that's money that's coming back to them. It's not going to a third party. So it stops the transfer of wealth that many people are concerned about in our society because the middle class is slowly shrinking because we keep transferring money to the upper classes, to the elites. And that's what Nelson Nash understood about infinite banking a long time ago, is that this is a way to stop the transfer of wealth from the lower and middle classes to the upper class.
When we discipline ourselves to save, it creates opportunity in other ways. And Jacob noticed this as he started saving, as he started using some of this money to go to the NBA games and to travel. His friends around him started commenting, well, you must be rich.
And to be truthful, we in America are very rich. When we compare ourselves to the rest of the world, we have it pretty easy here in America. We have the ability, the freedom that the American experiment has given each and every American is envied all over the world because we have the freedom to choose what we're going to do, not only what we believe, but what we do financially and how we react. And when we realize that and then put the freedom of being able to direct the flow of money back to ourselves after we purchase stuff, we can become even richer. And so explaining that to people shows that you don't have to make a lot of money. It's what you keep of what you make that makes you richer.
And with Jacob, he was saving his 10%. That was his policy premium. And then when he borrowed to take trips to travel around the world or to go to an NBA game, then he borrowed that money, but then he used 20% of his income whatever portion he needed to make loan repayments back for enjoying those things. And then the 70% he could live on. And that is the principle he had enacted. And his friends are saying, oh, you must just be rich. But he's realizing, no, I'm managing my money.
And the whole idea, the reason we want to be rich and to become richer is we want to be good stewards of what God has given us. That's the underlying motivation for doing this. If you have a different motivation, there are other motivations. Some people just want to get rich to heap it on themselves. That's not a good motivation. That carries detrimental consequences down the road. One of the things that we see with Jacob is he doesn't seem to be doing this. He recognizes the value of a stewardship mindset, where he can use the money and keep it flowing, and it regenerates. And that's the idea behind using riches in a positive way.
When we get back from the break, we're going to talk about what not using your money along the way could look like. It's called lost opportunity.
This is the Infinite Banking Made Simple binder. Everything you need to know about infinite banking in one spot, and it's a free download. Answers to the top commonly asked questions like what is infinite banking, how does it work, and how much does it cost to get started are answered right here. You'll find the step-by-step diagram starting on page 7 and the investment comparison on page 8. This Infinite Banking Made Simple binder is a free download. You can click the button to get your copy. At McPhee Insurance, we believe infinite banking has become too complicated and confusing, but it shouldn't be. And that's why we created this binder. Infinite banking is simple when you stick to the essentials and the facts, and the people who put it into practice get results. Don't let insurance terms like modified endowment contract, 7-pay test, direct recognition, and paid-up additions keep you from understanding infinite banking. Download the free binder and see how infinite banking can work for you.
Before I was married, I read a book called Business by the Book. It was written by Larry Burkett, and in that book, it teaches much of the same principles that Dave Ramsey teaches about finances. So when we got married, Michelle, we paid our house off in 5 years because that's one of the principles that they teach, is that you want to get out of debt as soon as possible. And they didn't differentiate between what a productive debt was and what a non-productive debt was. And they didn't ever talk about lost opportunity or opportunity cost. And so let's talk about that, because that is huge.
These people, they look at a mortgage, and let's say you have a $200,000 mortgage and it's at 5% interest. You're going to pay more than $200,000 just in interest by the time you pay that off in 30 years. I think it's like $217,000 of interest that you're going to pay. But if you pay cash for something, you're losing the lost opportunity cost that you could have earned. At just a 3% rate, you're going to end up losing more in lost opportunity if you pay cash than you would pay the bank in interest at a higher rate.
That is something that I never understood because I didn't think in percent. And people will say, well, you're only saving at 3% and you're paying 6% on this house or 5% or whatever it is. You're going to lose money. No, do the math. You've got to figure it out for the time factor. And that's where opportunity cost comes in. It's the time factor in this whole equation.
So let's do a real simple example of lost opportunity. You have $10,000 that you've saved at the bank. It's in a savings account earning 4%. You could use that $10,000 to make a purchase. And when you do, you're no longer going to be earning interest on your savings account. Over 20 years, that $10,000 would have grown to $21,900. The difference of $11,900 there, that represents lost opportunity. If you go 30 years, then your lost opportunity is going to be over $32,000. If you go 50 years, your lost that $10,000 would have grown to $71,000. That represents over $60,000 of lost opportunity.
You can take an even shorter time frame. Your dad did in his first book, Prescription for Wealth. You can get a copy, download a free copy on our website, mcpheeinsurance.com, or get the audio. But in there, he gives an example of borrowing from the bank while leaving your money in there, paying a higher interest than what you're earning. And it shows you gain by letting your money earn at a lower interest than what you're buying at. And you have to remember that you're paying interest on something, on a loan that is decreasing, while the amount that you have earning is increasing. And you actually make money when you're borrowing at a higher rate than what you're saving at. And it's a real simple example. You can follow it in that book.
Even a very short time period, you can see that difference start to develop. Over a long period, it just accentuates.
So just at 4%, you more than doubled your money in 10 years in this example that you gave, John. And that is the lost opportunity we never lose when we use infinite banking. Because when we store our savings in a participating whole life insurance policy, and we leverage that policy then to make a purchase, we don't lose that compounding growth over however long that policy loan is out. Now, if we don't pay the policy loan back and we don't pay the interest on the loan to the insurance company, then we could cut in to our profits that the policy is generating for us. But still yet, it is still growing just like it was guaranteed to. It's just that now we have introduced another factor, and that is the interest that you're going to pay anybody or lose yourself should you make a purchase with money. If I purchased a $10,000 piece of equipment, I lose the interest. In your case, it's 4%, John. I lose that compounding growth. If I make that same $10,000 purchase with a policy loan, I don't lose that compounding growth. Now, if I pay it back, I'm earning the interest that normally would go to somebody else, and I'm recovering the $10,000 that I used to make my purchase. And that's what infinite banking is all about.
There is always lost opportunity whenever we make a purchase for anything. But what is unique about the infinite banking concept is while we use the money, the policy is still growing and helping to offset that lost opportunity. It's a way to recover some of the lost opportunity. I mean, if we take the $10,000 example that I used earlier, we could spend that money today, or we could save it for the future. There's always a balance. We can use it today, or we can save it and prepare for the future. We have to make a decision between that, but when we can do some of both, that helps us to get ahead faster financially. I'm thinking my sister Eva just raised a hog, and the hog grew up, it went to the market, and now we have a freezer full of pork. We could save that pork in the freezer to stay prepared.
We could do that over the next 10 years even.
We could. It's not going to taste as good when we go to eat it in 10 years, but we could do that. We could also try to have pork every single night for dinner until we use it all up. Neither one of those is a balanced solution.
Michelle, when you go to the grocery store and you see beef or chicken on sale, you often will buy more than what we can eat that week. And you'll have them wrap it in a freezer bag or whatever, and then you put it in the freezer. And maybe the next week you go back and it's still on sale. You'll buy a little bit more and put it in the freezer, but you're always making sure you rotate that so that it comes to the forefront when you're going to use that beef, because you don't want it sitting in the freezer even a year, let alone 10 years.
Right.
And that's the real cool thing about infinite banking is even if we have stored money in life insurance and we're not using it, it's still rotating. It's still flowing because money has to flow to grow. It doesn't just sit there and grow automatically. It has to be in action. And the insurance company takes our premium dollars and they keep them in action. And that's where the compounding growth comes from. And that's why it's such a great tool to use to manage finances.
Having cash reserves, there's such a huge value in that. One thing that most financial experts can agree on is that you have to have an emergency fund, at least that much cash to cover a certain amount of living expenses before you start investing in doing more things. Most financial experts can agree on it. They might differ on how much you should have, or where and when you should accumulate that, but they agree that you should have it. And business owners, as they develop their business, they recognize the value of having a big cash pile. Think about Amazon. Jeff Bezos purchased Whole Foods. He had to get the cash from somewhere.
One of the biggest reasons businesses fail is they don't have cash flow. And having a reserve of capital in a participating whole life insurance gives us the cash flow we need when opportunities come up, when emergencies come up, or just when we want to take a vacation someplace.
It's so important to have that pool of cash. And so often when people are accumulating cash, it's sitting around doing nothing for them. And then when they use it, they miss out on that lost opportunity we were talking about earlier. So what better place to have your cash accumulations than using infinite banking? Use participating whole life insurance. You're building while you're accumulating your cash. And when you use your cash, you're not destroying the compounding effect.
Thinking of lost opportunity and the time factor that goes with it makes me think of this poem. The bride, white of hair, is stooped over her cane, her footsteps uncertainly guiding, while down the opposite aisle with a wan, toothless smile, the bridegroom in wheelchair come riding. Now, who is this elderly couple thus wed? Well, you'll find when you've closely explored it, that here's the rare, most conservative pair who waited till they could afford it. This poem gives us a funny little demonstration how there's more to be concerned about with just money when we're thinking about lost opportunity, because that elderly couple missed all those years that they could have been happily married together.
Michelle, that makes me think of Nelson Nash. He used to tell a story about having dinner with a couple of guys, and they were talking about lost opportunity, and one was saying, yeah, that's the key. We got to just cut down lost opportunity completely out of our life. And Nelson looked over him in his southern drawl, and he said, you know, Norm, if you were really that concerned about lost opportunity, you wouldn't eat another bite of food off your plate. And what he was saying is that we have to live. You can't rush to pay off your house just to recover the lost to not lose the opportunity. That doesn't make sense for so many people unless you have a cash cushion that's there to protect yourself once the house is paid off. So the life insurance that Nelson talked about in infinite banking was giving us that cash cushion, what allowed us to recover the opportunity cost on so many things in life. But some of the things we're never going to recover the lost opportunity on.
Because we have to live.
We have to live.
So, Jacob, if you're listening, obviously we've changed your name for privacy, but we just want to tell you we're really proud of you and what you've done. Keep going.
It's a pleasure working with our clients. We get to wake up thankful every day for being able to serve the people that God has connected us with, like Jacob, and to be a blessing in their lives.
Come back next week, right here on Wealth Talks, where we're going to talk more about money, finances, and how to create wealth in your life.